In this video, we are going to talk about how cryptocurrency fits into infrastructure bill. So before starting this video, like this video and subscribe to our YouTube channel for future updates. In the US Congress at the moment, tax reporting rules for cryptocurrency brokers, similar to how stockbrokers report their customers' sales to the IRS, are one way lawmakers want to pay for the $1 trillion infrastructure bill that the Senate adopted on Tuesday. It might pave the path for more stringent cryptocurrency regulation, which the Biden administration is pursuing while simultaneously promoting tax compliance. According to congressional accountants, the scheme may generate $28 billion in income over 10 years. President Joe Biden called this a generational investment comparable to the construction of the Transcontinental Railroad in the 1800s or the interstate highway system in the 1950s. As a result, currency that you can't hold in your hand would effectively pay for roads, bridges, water systems, internet broadband access, and shoring up the electrical grid. That's evidence of the recent exponential expansion of cryptocurrencies, an alluring potential source of income, and the growing pressure on certain government figures to tighten the controls on a largely unregulated industry. The bipartisan infrastructure bill was approved by the Senate on a vote of 69-30 after several weeks of debate. The House is now the next stop. An estimated $1.8 trillion has been invested in the cryptocurrency sector. They are essentially digitally signed lines of computer code that are transferred from one holder to another. They enable users to send or receive money anonymously because they are not connected to banks or governments. That appeals to libertarians, people who live off the grid, and risk takers among the younger generation who think the financial system is fixed. International criminals, money launderers, drug traffickers, and ransomware hackers also favor it. The most popular cryptocurrency is Bitcoin, which presently has a value of approximately $46,000 per unit, down from a peak of about $64,800 in April. It is notoriously volatile, sometimes rising or falling in response to comments made by Elon Musk, the controversial CEO of Tesla Inc. Bitcoin is currently accepted as payment by several companies. Ethereum, Dogecoin, Ripple, and Litecoin are a few other well-known cryptocurrencies. There are thousands in total. On exchanges, Bitcoin and other cryptocurrencies can be purchased and traded using US dollars and other national currencies. In particular, the development of blockchain, the digital ledger that records transactions, is seen by some politicians as a source of technological innovation in the cryptocurrency space. On the other side, senior American regulators are raising red flags. Gary Gensler, the Biden-appointed chairman of the Securities and Exchange Commission, stated last week that investors need additional protection in the cryptocurrency market, which he compared to the Wild West and said was rife with frauds, and abuse. Although the SEC has successfully prosecuted dozens of crypto fraud cases, according to Gensler, the organization requires more funding and legislative authority in order to effectively oversee the market. While everything is going on, the Federal Reserve is thinking of creating its own digital money that is pegged to the dollar. Faster payments between banks, customers, and businesses may be made possible by a so-called digital dollar. According to Suzanne Lynch, a professor at Utica College who specializes in financial crime, you've got federal agencies not talking on the same page. It's rather gloomy right now. The Senate's work on the significant infrastructure package was interrupted by the discussion of cryptocurrencies. Republicans opposed strengthening the IRS's authority, thus an earlier plan to pay for the measure by stepping up IRS enforcement to combat tax fraud by people and businesses was rejected. Over 10 years, that would have generated an estimated $100 billion in revenue. The idea for tougher tax reporting requirements for Bitcoin brokers was created after starting over with revenue-raising strategies. Only roughly 25% of the IRS crackdown proposal's projected revenue, or $28 billion, would be generated over a 10-year period. Nevertheless, it continues to be the infrastructure bill's main source of revenue. Some senators objected to it, and the Bitcoin sector and organizations that support internet freedom launched a lobbying blitz against it. Opponents argue that the measure unfairly places new tax reporting requirements on software developers and cryptocurrency miners, users who create currencies by lending computing power to verify other users' transactions and receive coins in exchange. This might stifle innovation, they claim. Opponents claim that those persons don't have access to the information the IRS would be gathering about cryptocurrency users. A compromise was reached after opponents proposed changes to the clause. However, it was rejected by the Senate, which sent the discussion on cryptocurrency, taxes, and brokers to the House. Although most Bitcoin brokers don't, some do already submit transactions to the IRS, according to experts. On the cryptocurrency exchanges, brokers place buy and sell orders on behalf of users. Users must provide personal information that can be used to contact them, and the exchanges must report their annual activity to the IRS. Cryptocurrencies are classified by the IRS as property, much like stocks or gold. If you sell it or cash it in at a profit, you must pay capital gains tax. Keep your cryptocurrency assets under 5% of your whole portfolio, according to experts. Because of the daily and extreme volatility of cryptocurrency prices, experts advise against investing more money than you could afford to lose if the market collapsed. Additionally, investing in cryptocurrencies should never take precedence over other financial goals like adopting more traditional investment strategies to save for retirement, pay off high-interest debt, or save for emergencies. The price of cryptocurrencies is known to fluctuate significantly throughout the day and even hour. Even the two largest cryptocurrencies, Bitcoin and Ethereum, frequently experience significant ups and downs, despite experts' recommendations that investors stick with these relatively more established currencies. Due to the fact that cryptocurrencies are such a new asset class, experts claim they are more prone to be influenced by a variety of factors, ranging from new government rules that affect it as an investment class to celebrity tweets about a particular cryptocurrency. Another clause extends the definition of digital assets under the U.S. Tax Code Section 6050I. Anyone who receives more than $10,000 in cash or equivalents is required by Section 6050I to file a report with the IRS. Information on who paid them, including names and social security numbers, is included in the report. Any failure to disclose information regarding persons sending funds is regarded as a criminal. When companies or exchanges receive more than $10,000 in cryptocurrencies, the infrastructure bill provision would demand something similar from them. Although Chandrasekhara claims it doesn't have any direct consequence on the end taxpayer, it will affect their privacy. Let's say you spend one Bitcoin, worth $60,000, buying a Tesla. Your name, address, social security number, and other personal information must be gathered by the car seller, the business, so they may report it to the IRS, says he. Cryptocurrency lobbyists like the nonprofit Coin Center have criticized this surveillance rule as unworkable and maybe unconstitutional. In the meanwhile, lobbyists for the cryptocurrency sector want to push for amendments and standalone laws to change the provisions since they won't go into force until January 2024. Before passing the legislation, the Treasury intends to conduct study to determine who could be required to comply and their level of readiness to do so. A Treasury official previously told CNBC make it years could pass during this process. The provisions in this law serve more as declarations of intent than as detailed rules. Ivory Johnson, certified financial planner, chartered financial consultant, and founder of Delancey Wealth Management, says it is up to the Treasury Department to determine who is covered by the provisions. The Treasury Department will have to issue instructions, similar to the broker definition. It would put cryptocurrencies at a fundamental disadvantage compared to other forms of traceable currency that have not been subject to cash reporting requirements if the regulations under the Act require online businesses receiving payments in cryptocurrencies, rather than via a fiat-linked wallet or credit card, to collect and report new types of information. Aside from that, requesting and disclosing a lot of information about the parties to a Bitcoin transaction could turn off clients who value their privacy or those who enjoy the ease and autonomy that come with managing transactions directly from their digital wallet. Customers of digital assets, as opposed to those who use traditional banking products, have easy access to a variety of private, unlicensed services that function outside the framework of regulated transactions. In light of this, a broad and unprecedented application of cash reporting requirements to cryptocurrency transactions may have the effect of luring customers away from industry players adhering to U.S. and international regulatory frameworks and towards a quickly developing market of unrestricted alternatives. A new class of brokers for digital assets faces difficulties as a result of the Act. Complex reporting, withholding, and other compliance issues can tempt users to switch their Bitcoin activities to non-US competitors for digital asset brokers with clients outside of the United States. Furthermore, if the cash reporting provision is widely implemented, it may conflict with the new broker reporting regulations and result in redundant and onerous reporting for the same transactions. What do you think about this video? Do let us know down in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.